So after all of this week's earnings reports and this morning's GDP report, it becomes clear that we almost have two economies. Things look good when the consumer's involved, not so good when you talk trade. What's an investor to do with this dual economy? Joining us tonight, we welcome back Liz Ann Sonders, the Chief Investment Strategist at Charles Schwab. Always good to see you, Liz Ann. Thanks for joining us.
Hi, Bill. Nice to see you and Sue, too.
So there are clear haves and have-nots right now.
Yes.
What do you do with that when you're trying to invest in this stock market right now?
So we think this is an environment, given some of the things you already mentioned, this bifurcation where you've got some decent strength in domestic industries on the consumer side of the economy, but weakness in business investment and confidence that business leaders have, is that and given that it's late cycle, you want to kind of snuggle up to benchmarks, so to speak. In other words, don't take undue risk. So what we've been telling investors really for about the last 2 years is keep your equity allocation no higher than whatever your normal long-term strategic allocation is. We have had an emphasis toward large cap stocks at the expense of small cap stocks. Small cap stocks generally have higher debt levels, they have lower profitability. Larger companies have a higher quality stream of earnings, and they can be more nimble around things like the trade war and tariffs. And then at the sector level, we're also relatively neutral. We only have one outperform rating right now and one underperform rating, the outperform being healthcare. So we think it is a trickier time, and that the best stance right now is not to try to make bets in one direction or another.
And does the interest rate environment with the Fed expected to cut next week influence that projection at all, Liz Ann, or not?
I think that an interest rate cut is ostensibly good for asset prices, for risk asset prices. It's been a support under the stock market. What I think, though, is the appropriate question to ask is whether that is going to fix what ails the economy. And I'm not sure the answer to that is yes. I don't think what ails the economy on the manufacturing side tied to trade and tariffs is that interest rates are too high. So it begs the question, will a cut in interest rates, a quarter point or even a half point, be enough of a solution to sort of reignite animal spirits, corporate animal spirits, which I think has been the biggest thing that has been damaged. And I'm not sure the answer to that question is yes.
Before we let you go briefly here, I mean, the market has waffled between defensive sectors and cyclical sectors. You seem to be suggesting to sort of take the middle ground here. Is that what I'm hearing?
I think what investors really should focus on is less so on things like sectors, but more so on factors. So I think what's important for investors to look at, especially if they're buying individual names, is stability of earnings, quality of earnings, companies that have rising earnings expectations. So it's that stability quality factor that, quite frankly, you can find across the spectrum of industries and sectors. And I think focusing on those factors is more important than just trying to hone in on a segment of the economy.
Liz Ann Sonders with Charles Schwab. We always appreciate your time. We'll let you get back to the clam bake. Enjoy the weekend.
Thank you.
Thank you very much.